has been so violent that it has shaken things up. I think it has done a lot of psyche damage to investors, and that's why silver is continuously kind of struggling. It's not making higher highs here, it's making lower lows. There's a lot of people aren't trusting the silver space. I think a lot of people, really got hit. Lots going on in the markets. Yesterday was a pretty big shakeup overall for equities and also for precious metals. We saw a wave of panic selling in the market, which triggered lots of selling in the precious metal space, which, as we know, or at least as I know, when we do enter a economic reset and we go into a stage 4 bear market, a decline, the panic selling, which hits day after day, week after week, will pull precious metals and everything down with it. And it's all about not holding those assets, but finding a way to navigate or profit from falling pricing, not buying and hoping that they're going to hold up. And so we got a lot of chaos, I think, just around the corner. But again, we got to let the markets figure itself out and take it one bar at a time. Now, today, Monday is holiday. It's Washington's birthday, so it is a long weekend. So hopefully everybody enjoys that. It's Canada Day here, or on Monday in Canada, so Canadians will enjoy that day off as well.
The broad market, led by the S&P 500 and the tech-heavy Nasdaq, is flashing warning signals. After repeated failures near resistance, momentum appears to be fading. The once dominant mega-cap technology cohort, often called the Magnificent Seven, is now testing critical support. A decisive breakdown could amplify downside pressure across global equities. These heavyweight stocks carry enormous index influence. If they weaken further, they could accelerate losses market-wide. Rising trading volume during declines suggests distribution rather than accumulation. Historically, when leadership falters, broader weakness tends to follow. The structure now resembles exhaustion rather than expansion.
Let's take a look at the markets. Let's start from the kind of the broad market, the S&P 500, and work our way down because we got some damage being done here across the board. Things look like the market is very close to a massive top or has topped and could be going for a landslide. So take a look. The S&P 500 got back up into resistance, got rejected again with some big volume. Our 30-minute chart shows us dipping into these lime green oversold market conditions. It has a rebound back up. We're starting to get some orange bars in here telling us the trend is going from up, which is green, to neutral, which is orange. If we take a look over at the Nasdaq 100, you can see the Nasdaq never got close to all-time highs. It actually just got stuck on the daily chart under resistance. It got rejected again. Big selling volume yesterday. When we look at the 30-minute chart, we're going between green and orange and red and orange and red again, telling us that the short-term trend is mixed, and currently it is in a downtrend. The Nasdaq is a powerhouse. If it is going to break down, it's got a lot of power. It's got some big stocks in there that will pull the rest of the indices down as well. So let's take a look. Let's break that down to the Magnificent Seven. And this is what we've been watching for a long time. Let's just focus in on the daily chart here. Get this drawn here. If we take a look, this is pretty significant. We've been talking about this for a while, that there's this very critical support level here for the Magnificent Seven, where if it breaks through here, breaks down, we could start to see a very big collapse. In fact, if we go back and look using Fibonacci retracement, we can say, okay, well, if this does peak right there, we could see the Magnificent Seven very easily break down from this level, and we could see it drop 7%, it could drop 13%, it could drop about 19, 20% to the downside. So it could very easily drop very quickly. This type of pattern is very similar type of setup and kind of momentum that is stalling out here. This one was a little bit more of, it was building a strong chart pattern, and then we had tariff news that unwound. This one is a little bit different in terms of it actually looks like a top. This one was kind of caught out of the blue with tariff news that's pulled it down. It actually had a pretty strong chart pattern leading up to that. This time it looks like the market is actually weak, and it is going to break down legitimately because of momentum in buying. Sentiment has actually shifted and changed gears from bullish to biased, or bullish to bearish, sorry. So that's kind of where we're at. If we look at let's just zoom back on the bigger picture here. The Mag 7 doesn't go back all that far, but we could definitely see a big haircut. 20% in this index from where it is right now will pull the indices down quite sharply. But let's go take a look. What else is moving here? So if we take a look where money has been flowing, we've been seeing this more often than not. Stock market sees some panic selling. We see some down days. We see money start to flow into the old guard, the old defensive plays. Bonds go up while stocks go down. We saw that yesterday.
As risk appetite cools, capital has begun flowing into defensive sectors. Utilities and consumer staples, traditionally viewed as stable havens, have attracted renewed interest. Bonds also experienced buying pressure, reflecting a search for safety amid uncertainty. This rotation often signals caution rather than optimism. Investors appear less interested in aggressive growth and more focused on capital preservation. Meanwhile, the volatility index has spiked, underscoring heightened anxiety. Put-call ratios suggest hedging activity is accelerating. When defensive assets outperform and volatility climbs simultaneously, markets are typically transitioning from complacency to caution, a shift that can mark the early stages of broader repricing.
We have utilities popping and really screaming higher. We talked about this basing formation, and now it's come to life. It might be a little bit overdone now. That move, I think, like that easy pop is now kind of done, but it's just telling us and showing us that people are looking for something they're comfortable with, a safe place to store their money. And we're definitely seeing that in the utility space. And this might want to continue to still move higher, but overall, definitely money has piled into the utility space. Consumer staples really popped and expanded yesterday as well. So that's kind of where money has been looking to go. Well, there was panic selling in the market. We saw gold and silver pull back. We saw the precious metal space pull back. Now if gold breaks down from here, we could see gold all the way down to about 4,000. It's about a 20% drop from where it is from yesterday's close. So there's some pretty good downside if gold is to break. Yesterday, we talked about how these are inside bars, inside this big red bar. This is known as a bearish pattern. At any point, this could work its way back up into this area, but at any point, this could break down and roll over. And if we were to just kind of use a Fibonacci retracement from the high and the power of this sell-off, if we carry that forward, you will notice this green line right here, the 618. So the market sold off and it's come all the way to the 618, which is a natural, it's kind of that last resistance area. And it got rejected yesterday, and this could end up moving and working its way down. So that's what we need to be aware of. Gold has had a nice drift higher. It does have a short term, I don't want to get everybody confused with the different time frames, but it does have this little pattern here, this rally up and this pullback, pointing to, which we talked about yesterday, this could drift itself back up to this 53.66 area, which would fill right into this inside candle, which then it would become a double top. It would be a double measured move because we have resistance plus Fibonacci target at the same level. It could easily have a big red bar, sell off, and then continue to break down in a pretty big way. So definitely got a lot of mixed signals in this space. And the fact that silver is pointing to downward pricing, it doesn't have a series of higher highs and higher lows for us to give a short-term upside target. The only target we can actually give on it is a downside target. So silver is pointing to potentially the worst scenario here is about a 61% pullback back down to 28, which would obviously wipe out and trigger some insanity in terms of margin calls and all of that stuff and catch everyone off guard who plays it off fundamentals, but don't follow the technicals. The technicals look pretty weak. I mean, even if this the more conservative pattern here plays out, it's still about a 45% haircut, brings us back down to about 41. So there's some pretty big downside risk, and we need to be aware of this. And the fact that silver is pointing to the downside.
Gold has shown resilience in the longer term, but short-term price action reveals vulnerability. After a sharp rally, consolidation patterns have emerged, and key resistance levels are being tested. Silver, platinum, and palladium appear even weaker, lacking consistent higher highs. When speculative enthusiasm fades, these metals can retrace sharply. Technical projections suggest significant downside risk if key levels fail. Historically, during episodes like 2008, metals initially fell alongside equities before later recovering. If panic selling intensifies, precious metals may temporarily suffer liquidity-driven declines before fundamentals regain control. The divergence between long-term trend and short-term weakness is widening.
We also have platinum pointing to lower pricing. We also have palladium pointing to lower pricing. They're not moving higher like gold is. And also copper is just ugly. It's putting in a topping chart, very much so kind of like the Magnificent Seven. It's just taken time. It's been bouncing. It looks like exhaustion. We do have some big selling volume going on here, so there's distribution. So again, a lot of things are telling us that the precious metal space is definitely struggling from a short-term basis. The flip side of that, if you separate the daily chart and zoom way back, the 150-day is still sloping up. And that is a sign that, the longer term trend, we're still within a major kind of bull market, but this is a pullback. And this is the type of pullback that's big enough that if we get the second half of this move, I really don't want to, hold on for something that could drop from the peak all the way down here, 65%, potentially even 75%, depending how this unfolds. And this is what I've talked about for a long time, is that silver could fall. The last time we had this scenario that we're in right now, silver fell like 65%. And that is what the short-term chart is pointing to. And I know it's not what a lot of people want to hear, but that's, again, what the chart is telling us. And that's what I like to follow. And if there's that much downside and that bearish of a pattern, I don't really want to hold it. So let's take a look over at miners. We'll look at GDX, but this is the same for silver miners, for juniors, really gold miners and silver, physical silver and gold. They're all the same trade. They all just move percentage-wise a little bit different. If we do a Fibonacci retracement, I haven't done any of this yet. We'll take a peek at the strength of this sell-off. We carry that forward. You can see it's come all the way up to the 618. It got rejected yesterday, just like gold did. If we do a Fibonacci extension of where this chart pattern is pointing to, so this sharp drop, this rebound back up, it is pointing to miners could fall from yesterday's close. They could fall about 13% from here. And if you look at the volume, it is pretty darn clear there is massive bouts of selling going on. People are unloading miners hand over, and they're just dumping them into the markets and all of that stuff. And there were some interesting stats the other day I kind of touched on. That right now we're seeing like crazy amount of volume in the stock market. The turnover of stocks are crazy. People are buying stocks at massive amounts, and people are also selling stocks at mass amounts. There's huge churning, meaning I think the general public is buying a lot of stocks. And I think big institutions have got their programs in place and they know what they're doing, and they're unloading shares into the hands of holders, general market participants, and lightening up. And we see this across the board pretty much everywhere.
Technology stocks and digital assets are showing fatigue. Major software names have broken down from extended formations, and cryptocurrency markets, particularly Bitcoin, mirror similar momentum shifts. Heavy trading volume in small and micro-cap stocks suggests speculative behavior near potential peaks. Historically, retail enthusiasm surges late in bullish cycles, while institutions quietly distribute holdings. When turnover rises dramatically without sustained upward progress, it often signals instability. The recent spike in speculative positioning could precede sharper volatility. Markets rarely announce their turning points in advance. They reveal them through subtle structural changes that gradually become undeniable.
Stocks too, Microsoft, things are breaking down. And Microsoft put in this massive ugly double top. It then broke down. And it's full on, in tumble mode, continuing to pick up speed. This actually looks a lot like Bitcoin, this most recent oversold sell-off. That's the software space. Software just has been hit very hard. In fact, let's take a look over at, let's just flip to Bitcoin. But Bitcoin's very similar. We're seeing a lot of money rotate out of growth stocks, out of Bitcoin, and just a lot of struggling. So going back to the point about a lot of volume being traded in the markets, it's kind of interesting here. We look at the IWC, which is the microcap space. This isn't a highly traded one, but it still is the same view of what's going on. I think in the stock market is relatively light volume. And then suddenly we've got huge volume in the microcap space. People are just going bananas and buying up stocks, and they're not really moving a whole lot higher. And we're seeing, a lot of shares trading. So somebody is unloading shares into the buyers. And this is usually the sign. The microcaps, let's take a look at IWM, which are the small caps. They're not showing quite as much volume. They're not seeing a big volume surge at all. It's actually relatively flat. So it's definitely in the lucrative plays. The micro caps is where the big volume, the majority of the volume is probably getting tallied up very quickly here. Cheap stocks, you trade a lot of them with the same amount of money. So volume spikes, and people usually go to the small aggressive stocks when they're really bullish. And typically people get highly positioned for big moves just before they change direction, right? I think the general public is getting excited for a big move higher in equities. And I think people are about to have a big, surprising, shocking move if the markets break down, which the Magnificent Seven have already broken down. Yesterday, they clearly broke down big volume or below this level. And we might see some hiccup of it trying to shake and recover for a bit. But overall, the momentum to me looks like we are going a whole lot lower. So just to take a look at the volatility index, we had a big spike in volatility. It's up again today. So expect big swings. We've got panic in the VIX. We have panic selling in the stock market yesterday. We have the put call ratio up 35% yesterday, closing above 1. Usually when we close up above here, the markets usually have some type of bounce, because when you close over 1, that means the majority of options traders are all buying put options. They're betting on falling pricing and they're using leverage. Typically, when we see that, means they have already sold their stock positions and now they're betting on falling pricing. And usually when we get that signal, usually the market has a bit of a bounce. So I wouldn't be surprised if we do get a bounce for a couple of days in the stock market, as things try to kind of shatter and break down. But overall, I do think we're going to start to really see a change in trend, and this stock market feels and looks like it wants to break down. And if it does start to break down in a big way, it could pull metals down with it. Usually in 2008, we did see stocks go down and money came out of stocks and into precious metals. We could see that. But if we don't, and we get into big waves of panic selling in the stock market, that panic will probably pull metals down. And the drop that we've seen in metals and silver has been so violent that it has shaken things up. I think it has done a lot of psyche damage to investors. And that's why silver is continuously kind of struggling. It's not making higher highs here. It's making lower lows. There's a lot of people aren't trusting the silver space. I think a lot of people, really got hit hard here, emotionally, trading account wise, all of that. Now people are really doubting, starting to wonder what's going to happen.
The long-term trend for certain assets remains constructive, but short-term turbulence cannot be ignored. Technical damage across multiple sectors suggests markets may be entering a more defensive phase. The key is adaptability, allowing price action to confirm direction rather than relying solely on narratives. Whether this develops into a deep correction or simply a volatile consolidation depends on upcoming confirmations. Investors must balance awareness of downside risk with discipline and flexibility. In uncertain environments, preservation of capital becomes as important as growth. Markets evolve bar by bar, and patience may prove to be the most valuable asset of all.